Welcome to the research desk. I want you to imagine, if you will, waking up tomorrow morning to the news that a single vital shipping lane in the South China Seas has just been effectively blockaded.
Right. And no shots even fired, just a sovereign decree.
Exactly. No shots fired, just a decree halting commercial transit. And within, seconds of that news crossing the wire, a meticulously crafted mathematical model on Wall Street, a model predicting over $1 trillion in artificial intelligence revenue, goes entirely to zero.
Poof. Gone.
Gone. So today, we are asking what I think is a truly terrifying question for allocators. Is Wall Street's most trusted valuation framework fundamentally broken? We are analyzing a $1 trillion dilemma that's sitting at the absolute center of modern equity markets.
We are. It's the big one.
The central question we must resolve today is whether Aswath Damodaran's legendary 4 levers of valuation, revenue growth, operating margins, capital efficiency, and discount rates, can actually survive the explosive, fundamentally unpredictable reality of the AI revolution. I'll be taking the stance that the framework is robust, and my colleague here will be taking the opposing view.
That's right. Because to understand the stakes here, we really only need to observe the recent, frankly, wild behavior of the market's heavyweights. I mean, look at NVIDIA.
Right.
We have NVIDIA experiencing a massive 265% stock surge, and that is driven purely by foundational AI demand.
Unprecedented velocity.
It is. And then we have Meta executing a ruthless, totally unprecedented pivot from its metaverse dreams directly into an era of hyper-efficiency. And of course, we have Tesla enduring these wild valuation swings driven less by actual automotive output and more by narrative shifts.
Right. And my position today is that Damodaran's framework remains perfectly equipped to handle this AI-driven hypergrowth. I mean, the model is not breaking. Rather, the levers simply shift their dominance as these companies mature through accelerated life cycles.
And my position is that the framework, at least as historically applied, is dangerously fragile in this specific era. I mean, we are not just dealing with accelerated growth here. We are dealing with extreme geopolitical and technological risks that act as, continuous rolling black swan events.
But those are just risks. You price them in.
No, these forces fundamentally break the traditional valuation levers. They render standard discounted cash flow models effectively obsolete when you are trying to price the vanguard of the artificial intelligence revolution.
I see why you think that, but let me give you a different perspective. Damodaran's levers are not broken. They are simply being stress-tested by extreme, unprecedented data inputs.
Well,
the architecture of the model, right? Discounting future cash flows based on growth, margin structure, and risk. That is a mathematical certainty. It is financial gravity. If we focus on historical analogs, the historical record proves the math still works, provided the analyst knows precisely which lever to prioritize at which stage of the company's evolution.
If they know which lever, sure.
Exactly. AI hypergrowth does not invalidate the laws of financial physics. It merely increases the velocity of the variables. We have seen hypervelocity before, and the spreadsheet always catches up to reality.
I'm sorry, but I just don't buy that. Let me tell you why. The premise that this is just a high-velocity version of the past completely ignores the structural reality of the present.
How so?
Today's market is governed by unquantifiable regime changes. We are looking at global chip wars, sovereign data localization, and algorithmic regulation. These are not standard risk premiums you can simply bake into a higher discount rate.
They're quantifiable if you try.
No, they are binary events. They render point estimate valuations completely useless. You cannot model a supply chain severing overnight with a gradual decay rate in a spreadsheet. Financial gravity assumes you are standing on solid ground. I am arguing that tectonic plates are giving way.
Okay, well, before we look at the friction points, we have to establish the common ground here. Because analyzing NVIDIA without looking at revenue assumptions is practically malpractice.
Fair enough.
Do we agree on the baselines? Sophisticated analysts must agree on 3 foundational realities derived from the data. Let me just walk through them quickly. First, the framework remains the most comprehensive method for isolating fundamental drivers.
Consider NVIDIA's $47.5 billion in data center revenue, and its staggering 126% growth rate.
It's massive.
Right. You cannot conceptualize that equity value without mapping those specific revenue growth assumptions. That is reality number one.
I can agree with reality number one purely on a mechanical level. If you are going to justify a multi-trillion-dollar market capitalization, you must point to the top-line driver. The $47.5 billion is a historical fact, and the 126% growth rate is the trajectory of that fact. I concede that Damodaran's framework isolates that revenue driver perfectly.
Excellent. So, reality number two. Life cycle stages dictate lever dominance. We see this vividly with Meta right now. Their current 29% operating margins and $43.9 billion in free cash flow loudly signal a definitive structural shift.
The pivot.
Yeah, they have moved from a pure growth narrative to an efficiency narrative. The dominant lever has shifted from top-line expansion to bottom-line extraction.
Again, the math is the math. Meta recognized the limits of user acquisition and pivoted to monetizing the existing base more efficiently. The 29% operating margin and the massive $43.9 billion in free cash flow perfectly illustrate a mature life cycle stage. I agree with reality number two.
Great. And finally, reality number three. Probabilistic thinking is completely non-negotiable here. A single point estimate will destroy your portfolio.
Oh, absolutely.
Look at Tesla. Its 8.2% operating margin tells a very small fraction of its story when its valuation routinely swings 30% purely based on discount rates tied to market perception. We have to view these assets as a spectrum of probabilities.
I agree with all three baseline observations. The data points you highlight are factually correct. NVIDIA's data center revenue growth is historic, Meta's margin expansion is a textbook efficiency pivot, and Tesla's valuation swings absolutely require probabilistic modeling.
So we're aligned.
But I must lay a trap here. Those baseline numbers represent a perfect, undisturbed snapshot in time. They assume the continuation of a trend in a vacuum. By agreeing on those baselines, we only agree on what the numbers are today.
Which is the foundation of analysis.
But that agreement severely masks the extreme structural fragility underneath those very metrics. The framework lulls analysts into a false sense of precision because the inputs look mathematically robust on a trailing 12-month basis. It is a financial equivalent of driving a car by only looking in the rearview mirror while accelerating into a fog bank.
Well, that supposed fragility is exactly what I want to challenge, because the framework actively adapts to these shocks. It doesn't just look backward, it maps the future if you know how to configure the inputs.
I'm listening.
Let us look directly at the bull case for Damodaran's methodology, proving the model handles corporate reinvention beautifully. I want to take the floor here and walk through the evidence, starting with NVIDIA.
Go ahead.
For NVIDIA, the revenue lever is the undisputed king of its current valuation. Data center sales exploded 409% year over year to $18.4 billion last quarter. When you see numbers like that, 409%, critics immediately claim the model breaks.
Because it does.
They say a standard discounted cash flow cannot handle a quadrupling of enterprise revenue. But history shows it does not break. Draw a direct parallel to Amazon's 1999 to 2001 growth phase.
Oh, come on. That is quite the leap. From silicon fabrication to selling books online.
The product is different, but the financial mechanism is identical. Let me explain why. During that 1999 to 2001 window, Amazon's revenue compound annual growth rate was 89%. That massive 89% CAGR completely dwarfed any concerns over their negative operating margins.
Right.
Wall Street analysts were pulling their hair out because Amazon was burning cash, but the valuation kept climbing. Why? Because the market intuitively understood that in a land grab phase of a new infrastructural technology, in that case e-commerce, revenue is the only lever that matters.
Okay, but
As Damodaran himself noted in 2022, historical analysis demonstrates that during these hyper-growth phases, revenue explains a massive 72% of valuation variance.
72%.
Yes. The model tells you exactly what to look at, which is top-line expansion, It filters out the noise of temporary margin compression.
Except Amazon in 1999 was selling books and expanding into domestic retail. They were relying on relatively stable, localized logistics networks. They were putting boxes on UPS trucks in Seattle and shipping them to Chicago. That is a highly predictable, domestic, physical reality.
It's still infrastructure.
NVIDIA, on the other hand, relies on the most complex, geopolitically sensitive supply chain in human history to generate that $18.4 billion. You cannot separate the financial mechanism from the physical reality of the product. Amazon's revenue lever was protected by the United States interstate highway system. NVIDIA's revenue lever is protected by nothing but a fragile geopolitical detente in the Taiwan Strait.
But the complexity of the product does not change the financial mechanism of the valuation. Whether you are shipping a paperback book or a $10,000 H100 GPU, the revenue lever functions the same way in the model.
I disagree.
But if you want to talk about maturity and stability, let us move past the growth phase and look at Meta to see how the margin lever takes over when growth normalizes. Reality Labs burned $4.65 billion last quarter. Wall Street naturally panicked.
As they should.
But what did the framework demand? Margin expansion. Mark Zuckerberg instituted the Year of Efficiency. He executed a 22% headcount cut. That is a brutal but highly effective operational maneuver that rapidly pushed operating margins up to 41%. This is not some unprecedented new paradigm of digital management. This explicitly mirrors IBM's 1993 turnaround under Lou Gerstner.
The Gerstner turnaround is a classic, but let's be precise about what happened there before we map it onto Meta.
Let's do that. In 1993, IBM was a bleeding giant. Mainframe revenue was collapsing, much like how Meta's core ad business faced an existential threat from Apple's privacy changes. As IBM's top-line growth slowed, operating margins became the sole driver of valuation.
Right. Gerstner cut costs.
Gerstner didn't try to invent a new massive revenue stream overnight. He restructured the cost base. He focused on cash flow. And that is exactly what Meta has done. Furthermore, capital efficiency now matters most for Meta, where every $1 billion in share buybacks boosts earnings per share by 3% at their current valuation levels.
3% per billion.
Exactly. The framework captures all of this. It shifts from revenue to margins and then to capital efficiency.
You are comparing Meta's digital advertising dominance to IBM's enterprise hardware turnaround. Yes, the mechanism of a headcount reduction improving a margin is obvious. If you fire 22% of your staff, your operating costs drop and your margin expands. A first-year accounting student can model that.
So you agree the model works?
No, because what the framework fails to capture is that Meta's margins are at the mercy of regulatory forces that IBM never faced. Lou Gerstner didn't have to worry about the European Union passing a law overnight that suddenly made IBM's mainframes illegal to operate in France. Meta faces that exact structural vulnerability with their algorithms.
I will address the regulatory environment shortly because it is crucial, but let me finish validating the framework with our third example, which is Tesla. Because even Tesla's extreme volatility perfectly fits this model. Let's look at the numbers. Tesla currently has 19% revenue growth.
Right.
In a traditional automotive context, say Ford or General Motors, a 19% growth rate would command a premium, but certainly not a tech-like 50x price-to-earnings multiple. That multiple seems irrational until you apply the correct lever. That multiple is a direct mathematical function of ultra-low discount rates being applied to highly speculative future cash flows from full self-driving and robotics.
So you are saying the market is just guessing at the future and assigning a low risk to that guess?
I am saying the market is pricing in option value, and we have seen this exact dynamic before. Look at Apple's 2007 iPhone bet. Before the iPhone even shipped, before it generated a single dollar of cash flow, the market compressed Apple's discount rate. They priced in the success of the paradigm shift. The framework handled it perfectly.
That's it.
Synthesize this whole dynamic. Think of the analogy of chess mapping to life cycle stages. Lever dominance shifts exactly like chess pieces. Pawns, representing revenue growth, advance first to control the board. They are sacrificed, they burn cash, but they capture territory. That is NVIDIA right now.
Okay.
Then the rooks, representing operating margins, are deployed to dominate the mid-game. They move in powerful straight lines, extracting maximum efficiency. That is Meta today. The framework beautifully explains the pricing of all three companies if you know which pieces are currently in play.
Okay. That's a compelling argument, but have you considered how these are not merely internal strategic adjustments, but macro regime changes that reset every single lever on your chessboard simultaneously?
I think the board handles it.
You are treating the board as if it is sitting on a stable table in a quiet room. I am arguing the room is on fire and the table is collapsing. Let us meticulously dismantle this bull case step by step, starting with your pawn, which is NVIDIA. You champion NVIDIA's revenue lever, assuming a continuous, stable supply chain. That is a fatal analytical flaw.
How so? Demand is there.
You cite the $18.4 billion in data center sales, but let's talk about how those chips are actually made. Taiwan Semiconductor Manufacturing Company, or TSMC, handles the fabrication. Specifically, they utilize a process called CoWoS chip-on-wafer-on-substrate.
I am familiar with CoWoS, but for our listeners, let's break down exactly why this matters.
It matters because it is a physical bottleneck that math cannot solve. CoWoS is an advanced packaging technology. It allows multiple silicon dies, like the GPU itself and the high bandwidth memory, to be stacked and interconnected on a single substrate.
Right, it's highly complex.
It is incredibly complex, requiring pristine clean rooms, highly specialized equipment, and extremely precise engineering. TSMC's CoWoS packaging bottlenecks could institute a hard cap on H100 GPU shipments regardless of how much demand exists from Microsoft or Google. You cannot model infinite revenue growth when physics and fabrication capacity dictate a strict ceiling.
But
if TSMC can only package a certain number of wafers per month, NVIDIA's revenue is mathematically capped.
But capacity expands. TSMC is pouring billions in capital expenditure to build out more CoWoS capacity as we speak.
Capital expenditure takes time. You cannot build a clean room overnight. And even if you could, you are still ignoring the black swans. We have historical precedent for supply chain black swans. Look at the 2011 Thailand floods.
That was a localized weather event.
People forget this, but Thailand was a massive hub for hard disk drive manufacturing. When the monsoons hit and flooded the industrial estates, it wasn't just a slight delay in shipping. The factories were underwater. That singular event wiped 30% off Western Digital's revenue overnight.
Wow, 30%.
It crippled the global PC market for quarters. Now apply that physical reality to Taiwan. The Carnegie Endowment explicitly warns that US-China chip wars could erase $47 billion in semiconductor trade. If that geopolitical event triggers an embargo, a blockade, or worse, your revenue growth projections are instantly moot. Damodaran's growth lever does not account for a sovereign nation halting the export of the very silicon your model relies upon.
I disagree completely. The model absolutely captures that, but it captures it through the denominator, not the numerator. It captures it through the equity risk premium. An analyst who is awake and aware of the Carnegie Endowment's $47 billion warning doesn't just throw their hands up.
So what do?
They simply adjust the discount rate upward to reflect that specific geographic and supply chain concentration risk. You demand a higher rate of return to hold NVIDIA equity because you know the Taiwan risk exists. That is how the math absorbs reality.
Adjusting a discount rate by 200 basis points does not capture a scenario where revenue goes to zero in a specific region. It smooths over binary destruction. A discount rate is a gradual decay function. Geopolitical conflict is a guillotine.
That's a dramatic way to frame it.
It's the reality. Now let us examine your rook, Meta. You praise their 41% operating margin and you lovingly cite IBM's turnaround. But Meta's margin recovery is intensely vulnerable to what political scientists term digital balkanization. You dismissed the regulatory threat earlier, but let me quantify it for you. India's 2023 data localization laws have already cost Meta $1 billion in lost revenue.
Explain the exact mechanism of that $1 billion loss. How does a localization law destroy $1 billion?
It breaks the efficiency of the algorithmic network. Meta's advertising model relies on ingesting massive amounts of global user data, pooling it, and training predictive algorithms to serve highly targeted ads. The algorithm learns from a user in Brazil and applies that insight to a user in Texas.
Right. Network effects.
But when a country like India passes a data localization law, they mandate the data generated by Indian citizens must physically reside on servers within India and cannot be freely exported to Meta's global algorithmic pool. It fragments the data. The algorithm suddenly has less information, making the ad targeting less accurate.
Which lowers return on ad spend.
Exactly. Advertisers see a lower return on ad spend, so they bid less for the ad space. That is not a competitive loss to TikTok or Snapchat. That is a sovereign decree erasing capital by breaking the core mechanism of the product. It is a preview of what happens when nations systematically fragment the internet.
That's just one market.
Look at the University of Chicago's 2021 study on GDPR, the European Privacy Framework. It proved that European privacy regulations reduced targeted ad revenue by 22% per user. Think about that. 22%. Operating margins do not exist in a regulatory vacuum. You cannot model long-term margin expansion to 45 or 50% when global regulators are actively writing legislation designed to fundamentally cap the profitability of targeted advertising algorithms.
Okay, well, regulatory headwinds are standard fare for mature monopolies. This is not a new phenomenon that breaks valuation modeling. Let's look at history. Tobacco, telecommunications, and standard media all faced similar balkanization and severe regulatory margin caps.
True.
When cigarette advertising was banned on television, tobacco margins were supposedly threatened. When the telecom monopolies were broken up, their pricing power was capped. Yet, traditional valuation models priced them flawlessly over decades. How? By compressing the terminal growth rate.
But data isn't cigarettes.
The market understood that these companies would become cash cows with limited growth and priced them accordingly. Meta will adapt. They'll build localized server infrastructure, and the margin will stabilize at a new, mathematically predictable baseline.
Digital data flows are entirely different from physical tobacco shipments. When you ban a tobacco ad, the cigarette still exists and still addictively generates revenue. When you ban data flows, the core intelligence of Meta's product is degraded instantaneously. The speed at which algorithmic regulation can alter Meta's core product is instantaneous.
I think you're underestimating their engineering talent to solve that. But
And finally, let us look at your defense of Tesla, which I find to be the most egregious misuse of the framework. You argue the discount rate explains the 50x multiple. You point to Apple in 2007. I argue the discount rate in Damodaran's model has become a dumping ground for unquantifiable risks. It is a mathematical sleight of hand to justify whatever price the market feels like paying today.
It is not a sleight of hand. It is a reflection of the cost of capital and the perceived risk of future cash flows.
Let me give you a specific, factual example of why it is a sleight of hand. When Elon Musk merely threatened on social media to move artificial intelligence development out of California, a late-night tweet, Tesla's stock dropped 12% in a single day.
Markets overreact.
12% of a mega-cap company's value erased by a social media post about corporate governance. There is absolutely no discounted cash flow model on Earth that captures a narrative shock of that magnitude based on a CEO's tweet. It is absurd to pretend we are doing rigorous financial physics here.
Its volatility is not.
Furthermore, consider the physical assets you are supposedly modeling. Tesla's Shanghai Gigafactory sits directly in a geopolitical crosshair. Meanwhile, 40% of the company's lithium supply physically crosses the highly contested South China Sea routes.
40%, yes.
These are not standard operational risks, like a labor strike or a supplier delay that you can tweak in a spreadsheet cell by adding a 0.5% to your discount rate. They are regime changes. If the South China Sea is blockaded, the discount rate does not increase. The company ceases to produce vehicles. The traditional levers completely shatter under this specific type of macroeconomic stress.
Well, this highlights a fascinating philosophical divide in how we interpret the market's behavior regarding these specific equities. We are looking at the exact same data points, the 12% drop, the Shanghai factory, the lithium routes, but we are interpreting the underlying mechanics entirely differently.
Fundamentally differently.
To capture this, we should rely on the specific analogies that define our distinct viewpoints. Your perspective relies heavily on qualitative assessment. You view Tesla through the lens of Hollywood versus tech narratives.
Yes, exactly. I think Hollywood explains Tesla far better than Wall Street does.
Break that down for the listener. You are essentially saying that Tesla's discount rate is its Rotten Tomatoes score. that investors are merely grading the story, the science fiction narrative of robo-taxis and humanoid robots, rather than strictly analyzing the automotive financials. You suggest sentiment drives the multiples, entirely detached from the underlying spreadsheet.
Exactly. Sentiment, narrative, and the suspension of disbelief. Traditional valuation assumes a rational, meticulous parsing of risk. The Hollywood analogy holds because a great story, directed by a masterful storyteller, can completely decouple a company's stock price from its cost of capital.
Like a movie.
When you go to a movie theater, you know you are looking at a screen, but a great director makes you forget the artifice. You buy into the reality. Musk is a master director. Investors buy into the narrative of a fully autonomous future. But here is the danger of a Rotten Tomatoes valuation. When the audience stops believing the script, when the timeline for full self-driving is pushed back for the 5th consecutive year, or when a tweet breaks the immersion and reminds everyone of the key man risk, the multiple collapses instantly.
The audience walks out.
The audience walks out of the theater. You cannot model a Rotten Tomatoes score using a risk-free rate and a beta. It requires psychological analysis, not financial analysis.
But that view completely ignores the underlying contagion of the actual technology. You are treating AI and autonomy as if it's merely a fiction. I counter with the analogy of epidemiology mapping to AI adoption. AI demand is not a Hollywood script that people can simply choose not to watch. It spreads precisely like a virus. It follows a mathematical S-curve of adoption, moving from early enthusiasts to total enterprise saturation.
A virus? Explain the mechanics of that analogy. Why is AI a virus?
Because of the compulsory nature of the demand. Let's look at enterprise software. When one major bank adopts generative AI to cut their coding time by 40%, every other bank in the world must immediately adopt it or face an insurmountable cost advantage.
Well, sure, they have to keep up.
The adoption forces further adoption. The reason point estimates in traditional growth models seem useless to you right now is that we are in the vertical, explosive phase of that S-curve. Hypergrowth follows predictable contagion patterns. It has a high R-naught value. Every major enterprise must adopt foundational AI or face extinction. The demand is compulsory, which means the revenue growth lever for NVDA, the supplier of the cure, so to speak, is far more resilient than you claim. It is an infrastructural necessity, not a fleeting narrative or a movie script. It is math.
Your epidemiology analogy is intellectually appealing, but it assumes the virus is allowed to spread without quarantine. It assumes infinite transmission vectors. That completely ignores the physical reality of the hardware required to run the software. I counter with the analogy of geology mapping to supply chains. Semiconductor supply chains are not viruses. They are tectonic plates.
Tectonic plates. So slow-moving, but immensely powerful.
Exactly. They are incredibly slow-moving. It takes years, 3 to 5 years, and tens of billions of dollars to build a new leading-edge fabrication plant. You have to pour concrete that is perfectly vibration-proof so the extreme ultraviolet lithography machines from ASML can pattern silicon at the nanometer level.
It's an engineering marvel.
A passing truck a mile away can ruin a wafer if the floor isn't isolated. It is the most complex physical manufacturing process ever devised by human beings. Yet, these massive, slow-moving tectonic plates are capable of sudden, catastrophic shifts. Access to rare earth minerals or control over a specific strait in the Pacific can make or break these hypergrowth stories overnight.
But that's always been true for hardware.
You are modeling the viral spread of software while completely ignoring the tectonic fragility of the hardware it runs on. A magnitude 8 earthquake in the supply chain, a geopolitical shock instantly neutralizes your S-curve. The software cannot spread if the servers do not exist.
Which brings us to the most complex mechanism in the entire valuation debate, right? The wild card of terminal value assumptions. Because even if we accept the tectonic fragility of supply chains, the mechanics of the valuation model dictate that the vast majority of these companies' value resides in their terminal phase.
The bulk of the iceberg.
Exactly. For our listeners, the terminal value represents all the cash flows expected after the initial high growth period normalizes into perpetuity. It is the bulk of the iceberg sitting underwater.
And that is precisely the illusion. Terminal value assumptions for hypergrowth companies are silently absorbing all the risk. It is a mathematical rug-sweeping exercise, because analysts cannot accurately map the unquantifiable geopolitical risks or the CoWoS bottlenecks in years 1 through 5. They push the required growth into the terminal value to justify the current sky-high stock price.
Let's look at the numbers on that.
Let us look at the raw math of this illusion. NVIDIA's current valuation effectively implies a 25% annual growth rate for a full decade. Think about what that actually means in the physical world. That is a scenario where artificial intelligence demand grows continuously and linearly, requiring doubling upon doubling of massive data centers, while supply chain bottlenecks miraculously vanish and geopolitical risks remain entirely static. History screams that this never happens.
It assumes 25% growth because the total addressable market for global compute infrastructure is expanding at that exact rate. The terminal value is not an illusion. It reflects a macro-architectural shift. It reflects the replacement of the entire legacy data center stack, the CPUs that have run the internet for 20 years, with accelerated computing and GPUs. It is a one-time, massive hardware refresh cycle. The math simply maps that reality.
But we must remember the historical warning of Microsoft's 1999 peak. During the height of the dot-com boom, Microsoft's valuation implied a linear, unending monopoly growth rate. The math mapped what seemed like an inevitable reality: a PC on every desk, running Windows.
And they achieved that eventually.
But when those growth assumptions finally corrected, when the market realized trees do not grow to the sky, and when the Department of Justice stepped in with antitrust litigation, it required 15 agonizing years for Microsoft's stock price to recover its previous high. 15 years of dead money.
Yeah, that was a brutal stretch.
And that was a software company. Microsoft had no South China Sea lithium exposure. They had no TSMC CoWoS bottlenecks. Their product was weightless code shipped on compact disks. Both of us must recognize that a linear growth model cannot survive contact with a non-linear geopolitical environment. The real margin of safety does not come from tweaking near-year growth rates by 2 or 3%. It comes from violently stress testing in these terminal scenarios. If NVIDIA's terminal growth rate drops from 25% to 15%, the stock price halves, regardless of what they report next quarter. The model is a house of cards balanced on a very specific assumption of infinite harmony.
Look, I concede that the sensitivity of the terminal value is extreme. You pull that lever even slightly, and the valuation swings by hundreds of billions of dollars. This forces us toward a necessary synthesis in our debate. The framework survives, but I will admit it survives barely. We're observing the financial equivalent of Newtonian physics facing quantum mechanics.
I like that framing. Damodaran's framework is Isaac Newton observing the apple.
Exactly. Damodaran's levers are Newtonian. They work flawlessly under standard conditions. They map the trajectory perfectly until they encounter extreme quantum conditions like artificial intelligence hypergrowth and global decoupling. NVIDIA mathematically proves that the revenue growth lever still utterly dominates early-stage valuation, but your point stands. It only dominates while TSMC fabs keep humming and the tectonic plates remain stable.
Right.
Meta definitively shows that operating margins matter most when a platform reaches scale. Unless, as you accurately noted, sovereign regulators rewrite the rules of data extraction and cause a quantum disruption in the algorithm. And Tesla clearly reveals that discount rates serve as the ultimate catch-all variable when Hollywood narratives trump fundamental cash flow analysis.
So we arrive at the breakthrough insight, the core reality of what these tools actually represent. Valuation levers are not mechanical dials an analyst simply turns on a dashboard in a vacuum. They are symptoms of deeper, fundamental competitive dynamics.
Exactly.
Revenue growth is not just a line item. It is merely a numerical reflection of innovation velocity. Can you invent faster than your competitors? Operating margins are not just accounting math. They are a direct measurement of organizational execution quality. How ruthlessly can you operate? And the discount rate is essentially the market pricing management's narrative credibility. Can the CEO convince the capital markets to fund the vision? The power of Damodaran's framework isn't in generating a perfect, impenetrable price target.
Its power lies in forcing the analyst to meticulously articulate exactly which engine is driving the value, even when that engine sits directly atop geopolitical fault lines.
Exactly. It provides the grammar to have this very debate. It gives us the vocabulary to measure the madness. And that grammar must translate directly into actionable allocations for our listeners. We cannot just theorize about tectonic plates and epidemiology. We have to construct the portfolio.
Let's get to the numbers.
Let us meticulously walk through every single portfolio recommendation provided by the research parameters. We will utilize the exact metrics mandated and debate the rationale for each specific action because this is where theory meets capital. Let's start with recommendation 1, overweight NVIDIA at a 7% allocation.
Okay.
The strict condition tied to this allocation is that data center revenue must sustain greater than 50% year-over-year growth. If quarterly growth dips below this 50% threshold, the position must be immediately reduced. I strongly support this rigorous conditional trigger. It relies strictly on the revenue lever. As long as the hypergrowth thesis remains mathematically intact and that pawn continues to charge up the board, you maintain the 7% overweight.
I accept the 7% allocation, but I only accept it because of the strict 50% threshold. The moment the velocity slows, the multiple will compress violently. But this leads directly into recommendation 2, which fundamentally hedges that exact NVIDIA position. Underweight pure-play semiconductor ETFs by 7%.
Which is fascinating. If we agree the geopolitical risk isn't fully priced into NVIDIA, how is the broader market handling it?
They are ignoring it. The rationale for this underweight is precisely what I have been arguing regarding the tectonic plates. Geopolitical risk premiums are absolutely not priced into broad instruments like the SMH or SOXX ETFs. The market is treating these semiconductor indexes like standard technology funds, completely ignoring the tectonic plate fragility underlying the entire sector.
So a rising tide lifts all boats, but a tsunami sinks them.
Exactly. If China acts on Taiwan or if export controls tighten further, the entire index collapses, not just one company. Therefore, you maintain the 7% underweight until or unless U.S.-China export controls demonstrably ease. You are shorting the geopolitical blindness of the broader market.
That is a highly rational pair trade. You capture the alpha of NVIDIA's specific execution and their dominant position in the AI infrastructure build-out, while simultaneously stripping out the beta of the sector's broader geopolitical exposure through the ETF short. It balances the Newtonian math with the quantum risk. Moving to recommendation 3, hold Meta at market weight.
Market weight, right.
The fundamental rationale here is that their current 29% operating margins have clear, quantifiable upside to 35% through continued efficiency gains and the integration of AI into their ad stack to lower the cost of content generation. However, the regulatory risk we discussed, the digital balkanization, places a hard cap on multiple expansion. Therefore, a market weight position captures the margin improvement without over-indexing to the sovereign risk.
I agree. You are playing the rook in the mid-game here. You are focusing purely on execution quality while acknowledging the regulatory ceiling. You get the benefit of Zuckerberg's efficiency without betting the farm that the European Union will suddenly embrace frictionless data harvesting. It is a sober allocation.
It is. Now, recommendation 4 shifts to the most volatile asset in the portfolio. Short Tesla volatility via options. Specifically, the recommendation dictates that when the 30-day implied volatility exceeds 60%, executing short strangles becomes highly attractive.
The strangle.
Let's explain that mechanism for our listeners who aren't trading advanced options daily. What is a short strangle and why use it here?
Well, a strangled involves selling both an out-of-the-money call option and an out-of-the-money put option at the same time. You are essentially building a mathematical fence around the current stock price. You collect the premium from the buyers of those options, and you keep that premium as long as the stock stays inside your fence until expiration.
So you're betting against extreme movement.
Right. The rationale here relies on the 30-day implied volatility exceeding 60%. When Elon Musk tweets something controversial, the narrative shock makes options premiums explode. The market panics. By executing a short strangle, you are acting as the casino.
You are selling overpriced insurance to panicked investors who are confusing a 24-hour narrative crisis with a fundamental long-term shift in automotive demand. Tesla's extreme discount rate sensitivity to Musk's tweets artificially inflates near-term options premiums, allowing us to harvest that panic.
It is the perfect application of the Hollywood narrative analogy. You are literally monetizing the audience's overreaction to the script. When the audience gasps at a plot twist, you sell them popcorn at a markup. Recommendation 5 introduces a defensive growth vector to balance the portfolio. Add AI cybersecurity, specifically CrowdStrike and Zscaler, at a 5% total allocation.
Cybersecurity. Yes.
The rationale here is anchored by Gartner's explicit forecast of a 24% compound annual growth rate in AI security spending through 2027. Geopolitical tensions are not a risk here. They actively accelerate enterprise adoption of these platforms. When nation-states use AI to attack corporate infrastructure, those corporations must buy AI defense.
It is the epidemiology S-curve applied to corporate defense. It is compulsory spending. You do not cut your cybersecurity budget when you are under attack. It is the purest form of software revenue resilience.
Now, Recommendation 6 requires severe operational vigilance from the analyst. Monitor TSMC CoWoS capacity reports. The strict condition here is to look for confirmed expansion announcements, pushing capacity above 120,000 wafers per month.
120,000, that's the magic number.
Reaching that 120,000 metric is the only mathematical way to ease NVIDIA's supply constraints, thereby validating the continuation of their dominant growth lever. You cannot just read NVIDIA's earnings. You must monitor TSMC's capital expenditure reports to verify the physical capacity exists to meet the software demand.
Which perfectly sets up Recommendation 7, the absolute capstone of the portfolio strategy. Build scenario lattices. Absolutely no point estimates. Do not use a single discounted cash flow model to generate a single price target. The exact model requires assigning probabilities across a spectrum of futures. You model NVIDIA needing a 40% probability for a $300 price target, a 30% probability for a $200 price target, and a 30% probability for a $100 price target.
Let's contextualize those targets. The 40% probability for $300 is your S-curve, utopia, frictionless AI adoption, and perfect supply chain execution. The 30% probability for $200 is the Newtonian reality, growth slows, margins compress, normal business cycles apply. And the 30% probability for $100 is the tectonic plate shifting, export controls, CoWoS failures, or a Taiwan blockade.
I must praise this scenario lattice, assigning a 40, 30, and 30% distribution for targets of $300, $200, and $100 is the only sane, mathematically sound way to model quantum market risks. It forces the analyst to explicitly price the catastrophic downside alongside the hypergrowth upside.
It proves that the framework, when adapted probabilistically, remains the most vital tool we possess, which brings us to the bottom line of this entire debate. Damodaran's framework is less of a rigid calculator that spits out a perfect answer and far more of a flashlight for dark corners. It will not predict the future, but it illuminates precisely where to look when navigating the intense complexities of hypergrowth. As the research explicitly concludes, and I quote, "The most valuable companies today aren't those with the highest growth rates, but those whose organizational anti-entropy can sustain their dominant valuation lever just long enough for the next lever to take over."
That organizational anti-entropy, the ability to resist chaos and execute a pivot, is incredibly rare. While we agree on the portfolio mechanics today, our core disagreement remains unresolved. You still trust that the mathematical reality of these levers will ultimately overpower the macro risks. You believe the flashlight is enough.
I do.
I maintain that in this specific era of technological contagion and geopolitical fracture, macro risks can, and eventually will, shatter the models completely. The listener must decide whether they ultimately trust the purity of the math or fear the sudden violence of the geopolitics. In the end, the market isn't truly pricing discounted cash flows. It's pricing a company's ability to keep reality from breaking its meticulously crafted story. This is the Research Desk officially signing off.